Good afternoon, ladies and gentlemen. Thank you all for joining us. We will get started in just a few moments as we are waiting for everyone to log on.
Buenas tardes, damas y caballeros. Gracias a todos por acompañarnos. Empezaremos en solo unos momentos mientras esperamos a que todos inicien sesión.
Once again, thank you for joining us this evening as we kick off our statewide insurance market update. My name is Julia Juarez. I am Deputy Commissioner for Community Relations and Outreach at the California Department of Insurance. We will now go over a few housekeeping rules. Audio,
Gracias por
video, and
acompañarnos.
chat will be monitored and recorded, and by default, all participants will be muted and video is disabled. This event is being streamed live on Facebook at Insurance CAGOV. We respect all our participants in this convening today and want to create a
Gracias por
safe
acompañarnos esta
space
noche
for
mientras
all.
esperamos nuestra actualización estatal
And
de mercado de seguros. Mi nombre es Julia Juárez. I'm sorry, please proceed, ma'am.
thank you. We will have video on for the speakers only, and previously submitted questions will be answered as part of the program. Before we get started, I would like to introduce our Spanish interpreter, Alan Cepeda, who will provide instructions to our Spanish speakers.
Buenas tardes, mi nombre es Alan Cepeda y vamos a brindar instrucciones a los hispanohablantes.
Alan, would you be able to go on to the Spanish interpretation? How people can access that?
Interpreter speaking here, I believe the lady previously, she was able to send me to the room.
Okay, so we will be able to send you to the room. Para los hispanohablantes, vamos a tener un cuarto específicamente para ustedes para que puedan escuchar todo en español. Muchas gracias. For today's event, we will be joined by Carolyn Kowski, founder and executive director for Insurance for Good, and Amy Bach, founder and executive director for United Policyholders. Our conversation today will be focused on California's homeowners insurance market. We are seeing the market showing early signs of stabilizing, and new analysis indicates a possible slowdown in fair plan growth following the implementation of the sustainable insurance strategy. We will go over what is working, what is next to expand coverage options, and key reforms that will strengthen the long-term market health. I would like to thank all of you who submitted your questions prior to the event. Our hope is that through the conversation, your questions will be answered. But if we did not address your particular question, please contact our Department of Insurance experts at 800-927-4357, and they will be able to help you directly. We are having a little bit of trouble connecting with Insurance Commissioner Ricardo Lara, but we want to respect everyone's time, so we will continue on. And so I will share with you the information Commissioner Lara was going to be sharing with you. Um, we understand that insurance has become one of the biggest concerns for families across California. Only a few years ago, insurance was an afterthought for homeowners, and very much so now it is in the forefront of everyone's minds. Whether you've received a non-renewal notice or struggle to find coverage or are worried about rising costs, I want you to know that your concerns have been heard. We have been to every county in the state, and we have heard the same types of questions. Will I be able to keep my insurance? When will I have more choices beyond the FAIR plan? What is being done to make things better? So those are all very important questions, and they are exactly what the department has been working on to strengthen the insurance market while protecting consumers, which is our mission overall. So when Insurance Commissioner Lara came on board in 2019, the market as a whole was under tremendous pressure. More insurance companies were pulling back, and too many homeowners were left with limited options for coverage. And so as a result, more Californians found themselves relying specifically on the FAIR plan because they couldn't find insurance elsewhere. Standing still wasn't an option. And so Commissioner Lara launched the Sustainable Insurance Strategy to create a healthier insurance market while preserving the strong consumer protections Californians count on. He has said from the very beginning that success wouldn't be measured by the headlines, but rather by the results that the department uh, produced. And so today we are seeing some encouraging signs that the story is starting to change. And so under the Sustainable Insurance Strategy, 11 homeowner insurance groups have now committed to stay and grow in California, along with 2 commercial insurance groups. And they are writing more policies and expanding coverage, including in communities where finding insurance has been especially difficult. So Commissioner Lara were able to join us. Thank you very much for being here. And I will give the floor to you.
Hey, Julia. Sorry about that. We're in the middle of legislative session last couple of weeks. So we're having conversations with legislators. Good evening, everybody, and thank you for joining us. Julia, you stole our thunder, which is great. Before we begin, I just want to thank our guest tonight, Carolyn Kuski from Insurance for Good, and the incredible Amy Bach from United Policyholders, both who have spent many years working on these issues, studying the trends and helping consumers navigate some of the most difficult challenges in the insurance marketplace. I want to thank you all for taking the time out of your evening to be here with us. And I want to start with something simple. I know many Californians have been worried, as Julia said. Some of you have struggled to find insurance. Some have received non-renewal notices. Some have seen premiums rise. And some are still recovering from wildfires, smoke damage, floods, and other natural disasters, and have been asking the same question: Is it ever going to get better? And that's why we're here tonight. We all lived through some incredibly difficult years. Homeowners have felt it, renters have felt it, wildfire survivors have felt it. In fact, the entire communities have felt it. And for many Californians, insurance went from being something you rarely even thought about to something you worry about constantly. And that's not how it should be. One thing I think is important for Californians to understand is that what we're experiencing is not happening only here. Today, insurance companies are dealing with record wildfires, floods, hurricanes, severe storms, and extreme heat all around the world. These losses are affecting insurance and reinsurance markets in Europe, Canada, Australia, of course, across the United States. And I want to point out that in particularly this past July has been particularly devastating globally, and will certainly have repercussions for our market in 2027. California's insurance market is part of our global insurance market, and that doesn't excuse and I want to also be clear that that doesn't excuse the challenges people have experienced, but it does provide important context. And when I became insurance commissioner, I know Julia was mentioning this in our department, it became clear that standing still was not an option. We could continue watching more families lose options. We could just pretend that the FAIR Plan wasn't growing, and we could have just kind of hoped that the market would fix itself like many others did before, or we could act. Doing nothing wasn't an option, so we chose action. We launched the Sustainable Insurance Strategy, as Julia was mentioning, which is really a comprehensive effort to modernize our insurance market while also preserving consumer protections that we all depend on. And let me be candid, these were not easy decisions. Some of them were very controversial. Some of them required changing outdated systems that had not been updated for decades. None of them offered overnight solutions. But it's also important, to understand that leadership during a crisis means making difficult decisions before everyone agrees with them. And it means focusing really on long-term stability instead of, the short-term applause. And today, for the first time in several years, you're going to hear from experts that we're beginning to see encouraging signs that some of those efforts are working. More insurers are filing. More insurers are expanding, yes, in California. More options are beginning to return to California for the first time. And companies representing many of California's largest homeowners, as Julia was mentioning, insurers have committed to stay and actually grow in our state. That's exactly what we set out to achieve. We're also seeing other encouraging signs. The FAIR Plan growth is slowing, and I'm confident that soon, very soon, we will see the first ever decline in FAIR Plan policies. Now, Carolyn Kuzi is going to talk about that. That doesn't mean the work isn't finished by any means, but it does suggest that more Californians may once again be finding options in the traditional insurance market. And that's very important because what I said since the beginning, the FAIR Plan is a safety net, not a destination. Now, let me be clear. I am not counting a victory lap by any means. Affordability remains a challenge. Again, affordability remains a challenge. Some communities are still struggling. Climate risk is not going away, but we are no longer asking whether California has a plan. We have a plan, we are implementing it, and we're beginning to see results. That's why we chose the title of tonight's conversation. Well, actually, Julia and her team chose it. From crisis to stabilization, because that's where California is today. Not at the finish line, not mission accomplished, but moving in the right direction. We will also talk tonight about something equally important, what homeowners can do. We are not helpless here. The future of insurance isn't only about regulators or insurance companies. It's also about safer homes, safer communities, creating defensible space, hardening homes against wildfire, building stronger neighborhoods, reducing risk, because a safer home is often a more insurable, more investable home. And communities that reduce risk put themselves in a stronger position for the future. So also, as I look forward to the final chapter in my time as insurance commissioner, my focus will always stay the same. Leave California's insurance market stronger than how I found it. Not headlines, not politics, but for more families to depend on insurance to protect their homes, their business, their futures, and their number one investment, their property. So we still have a lot of work ahead of us, but for the first time in a long time, the evidence, the data, and the facts all point in the same direction. California's insurance market is finally moving forward. You don't have to trust me, trust the facts and the data. That should give us reason for cautious optimism. So thank you for joining us tonight. Julia, I've taken way too much time, but I just want to thank you for joining us tonight.
Thank you, Commissioner. We do have some questions that did
Oh,
come
okay.
in. So if it's okay with you, we will just get
Sure.
into those. And the first question is, what is being done to reduce homeowners insurance costs, prevent unaffordable increases, including escrow shortages, and provide rate relief, especially for seniors and fixed income households?
Absolutely, absolutely. Our seniors and our folks that are on fixed incomes. It's no secret that the last few years have been incredibly difficult for our homeowners, our renters on fixed income, and people have every reason to be frustrated. Many people in Californians have dealt with non-renewals, like I said, rising premiums, fewer options, and greater reliance on the FAIR plan. And I know these challenges can be specifically difficult for our seniors and families living on fixed incomes. That's exactly why we launched our strategy. And the goal is really simple. I want to just try to simplify it as much as I can. Expand availability, restore competition, and protect consumers. Really, that's what it boils down to. One of the realities we had to confront was the California insurance system was not keeping up with today's risks. We were operating with 20th century regulations for a 21st century problem. And we needed a framework that reflected the world we're living in today while continuing to protect consumers. And at the same time, the flexibility for insurers must come with responsibilities. They wanted new tools, but we needed to put real responsibilities on them. So if an insurance company received the new tools, Californians should receive something in return. More coverage and more choices. That's really what it boils down to. That's the guiding principle behind the strategy. When it comes to affordability, I want Californians to know something that competition absolutely matters. When customers have more choices, companies have to compete for business. And in a healthy market, it creates better long-term outcomes for consumers. Now, we know that insurance companies are not utilities. They're not obligated to stay in the market. And that's what we're seeing. Insurance companies leaving. And any attempts to try to make them stay, we've lost in court. So now we're not at the finish line yet. There's still work to do, but there's also things that homeowners can do right now. We encourage everyone to look at our Safer from Wildfires. You're going to see in the chat more of information like that, what you can do. And those are things like creating defensible space, maintaining ember resistant zones. You're going to hear that from the great Amy Bach, upgrading vulnerable parts of your home, working on with your neighbors for community-wide mitigation. Because at the end of the day, reducing your risk not only protects your home, it strengthens the insurance market over a long term. So that's what we want to get to. Long-term stabilization.
For everyone. When will California's homeowners insurance market stabilize? Basically, with more admitted carriers writing policies again, including specific counties and zip codes, and when will meaningful consumer choice return?
Well, we're already starting to see that now. Quite honestly, I mean, we're starting to see insurers come back. We're starting to see more filings come back. We're starting to see, for example, for several years now, Californians have heard the same story. Insurance companies are leaving. The market is collapsing. Nothing is being done. But the data we're seeing today tells a more nuanced story. Companies are expanding now. New companies are entering the market for the first time in years, I might add. Actually, new companies are coming into California. Nobody's read those stories, right? More companies are filing. The FAIR plan is slowing. These are all encouraging signs. And I often say that, I always joke around that I want to make insurance boring again. I don't want people worrying about their insurance because, we're trying to protect your home, and boring is actually pretty good. I want you to not worry about it. But, finding insurance should not be one of the most stressful parts of home ownership. So today we're beginning to see early signs of stabilization under the strategy that we did, and that's what we designed, how we designed it. So today doesn't mean that every challenge has been solved, as you know. Now we have the lineage fire that we're trying to now look at these large industrial complex fires and the multiple insurance gaps that surround that issue. And it doesn't mean that every community will see immediate change, but it does mean that we're seeing measurable signs that the market is responding. That's not a talking point. That's not a headline. That is what the data is showing. And you will hear some of that today. We're moving in the right direction, and my department will continue to monitor the market and hold insurers accountable for the commitments that they've made. So you'll start hearing some of that today.
And the last question for you, so that we don't keep you on the same
Not me.
subject.
We're not
Yes,
keeping the expert.
everyone
We're talking.
But I want to make sure that
Nobody wants to hear from me
that we
anymore.
get, we get the general questions that we received. The last one is, how is the state ensuring carriers use accurate replacement cost estimators, consider modern risk models, and then comply with the sustainable insurance strategy commitments, and so that they can avoid unfair cancellations for long-time customers?
Well, as you know, with the sustainable insurance strategy now, we actually can hold insurance companies accountable for the first time because we're going to be tracking that data. Before, they would just leave a market and there was no way of holding them accountable. Now, through this agreement, they have signed an agreement saying that they were going, if they want to use these tools, they have to grow and can no longer abandon a community. So, like, for example, back in the day, when the fires happened in the Palisades and in the Eaton area, like they did in the 90s, they just up and left and then came back once everything was rebuilt. Now, with these last fires in January, they can't leave. They cannot leave the wildfire distress areas up in Paradise or in Sonoma County or in the current fires that we just have and are currently experiencing in the Inland Empire, because we're holding them to that. And now we have the technology through modeling and tracking to make sure that they're growing in these communities that we've identified as priority areas. And if they're not, we can go after them legally for the first time ever. And guess what? We are the only state in this country that has that agreement with the insurance companies. And I'm very proud of that we were able to achieve that. So not only are we going to hold them accountable, we're going to be tracking that, and we're going to be able to see that in real time. And we're going to be able to share that information with our local governments, our mayors, our governor, our legislators, so that we're all seeing this data now. And that's going to be incredible.
Absolutely. Well, thank you so much, Commissioner. We are also delighted to be joined by Carolyn Kowski today, who is a leading economist and expert in disaster insurance and climate risk management. She is the founder and executive director of Insurance for Good and a contributing economist at the Environmental Defense Fund. She is the vice chair of the California Climate Insurance Working Group, a member of the Federal Advisory Committee on Insurance at the U.S. Department of Treasury, and is also the author of the book, Understanding Disaster Insurance, New Tools for a More Resilient Future. So Carolyn, thank you so much for joining us today, and we are eager to hear what you are going to be able to share with us.
Thank you so much. It's a real pleasure to be here. Let me share my slides for you. I'm going to assume you're seeing those unless you interrupt me to say otherwise. Okay, great, thanks. So I'm just going to take a few minutes to walk through some of the recent dynamics we've been seeing sort of at a high state level market level in the residential property insurance market, and maybe underscore some of the things you just heard from the commissioner with some charts for you to look at. Okay, so I'd like to start this conversation around the 2017 and 18 wildfire seasons, which were, of course, the most damaging before the LA fires, because a lot of the dislocation in the California market begins showing up in the data at a high level way, in a kind of serious way, after those two fires. Those two fires wiped out more than a quarter century of cumulative underwriting profit twice over for the homeowners insurance industry. That doesn't mean they went insolvent. They have their investment income and other things. Only one firm did. But it does mean that it was a big shock to the industry in terms of the magnitude of the losses and a wake-up call on how wildfire risk was growing and how severe it really could be. And so in response to that, we start to see a number of changes unfold in the high-risk areas of the state of California. And what's been happening has been very different in the very high fire risk areas than the rest of the state. And it's really like these are two different markets operating in the state. So you can find all of the charts I'm about to go through and show you up on our website at that link if you want to look at them in more detail or read more detail about them and the data sources. But everything I'm going to show you in the next few slides is broken out by quintiles of fire risk within the state. We took all the zip codes and then we mapped them to fire risk as measured by insurers themselves. So our measure of wildfire risk here is based on the average fire risk scores that the industry is using and reported to CDI in their wildfire risk report. And I want to highlight one thing here for everyone. So yes, fire impacts a lot of California. We know that for sure. But also it's very uneven in terms of burning, right? Not in terms of impacts like smoke, which really travel. So less than 5% of residential structures in the state are in those very high fire risk zip codes. And yet those zip codes have seen almost 70% of the insured losses in recent years. So this kind of small, very high fire risk area is responsible for a large share of the fire losses. And we actually see that kind of pattern for many different disaster perils around the country. So after those fires, there was a spike in non-renewals, as has been talked about a lot. That's up on our website if you want to see it. It's not shown here. But in addition to the non-renewals, even after moratoria ended, we also see beginning in about 2020, this really serious decline in the number of policies in the admitted market in those very high fire risk areas and only in those areas. So that's this big red line here, the high fire risk areas. And you see a drop off of about 40% in admitted market policies in these zip codes. The lower risk areas of the state, though, are not suffering this problem. And indeed, we see that policy availability in the admitted market is even growing somewhat in the lower risk areas. So when the admitted market pulls back like this, what happens? Well, as we all know, people are pushed into the FAIR plan. I don't need to spend time here going over what that is. I'm sure everyone on the call is quite familiar with it. But we see that commensurate increase in the very high fire risk zip codes in policies in the FAIR plan, which is what you see here over that same time period. So as they pull out of as admitted market insurers pull out, people have to go to the FAIR plan. But then as the commissioner noted at the top, that increase, which was so steep, right, for for all these years here between this is about 2018 going up to 2024, is finally really starting to stabilize. And the last 4 quarters of reported data from the FAIR plan really show this leveling off now. And the increase in use of the FAIR plan has been, a little bit in the moderate areas and not at all in the low risk areas of the state. And so you can see that this is really a story of the high fire risk areas, but it's not just a story of the risk, it's how the risk couples to the regulatory environment to allow insurers to have the flexibility and the use of the modern risk management tools you heard about from the commissioner to be able to cover catastrophic and growing risks. And when they have access to those tools, they're more able to underwrite fire risk. But before getting to that, I want to stress how this increase in policies in the FAIR plan really means it's playing this very different role in different zip codes in the state. So this is showing you the market share of the FAIR plan. So of all the residences in a zip code, what percentage have to find their fire coverage in the FAIR plan? And you can see statewide, it's grown a little bit. Statewide right now, I think it's up to about 6% of policy holders statewide have to rely on the FAIR plan, but 94% are finding coverage in the admitted market. But in those very high fire risk zip codes, it's really different, right? Here on average, it's over 40%, which means there's some zip codes where 50, 60, 70, 80% of residences are having to rely on the FAIR plan in those high fire risk areas. On the other hand, in some of the low risk areas of the state, less than 1% of people are needing to use the FAIR plan. So again, these really kind of differences depending on the wildfire risk. We have all the FAIR plan data up in an interactive map on our website if you want to go in and click to a specific zip code, see the market share, see the policy counts. So I think what we take away from this, hopefully you're seeing the same thing. If not, let us know. But what we take away in looking at this is that there's really this tale of two markets happening in the state. In the highest wildfire risk areas, non-renewals went up, new business declined, fair plan expanded, and also I don't show it here, but it's on the webpage, market concentration has also been increasing. A higher concentration index means fewer insurers are providing a larger share of the coverage. That means less competition. And competition is good for consumers. When we have competition, we tend to have better coverage and lower prices. So on all these metrics in the high wildfire risk areas, things were not looking good until they've recently started to stabilize, right? But in the lower risk areas, the insurance market on all these metrics looked pretty healthy. Market concentration was tending downward. Fair plan concentration was low. People were able to find coverage in the admitted market. Okay, so insurability in these communities, as I said, is really this combination of growing fire risk, which we still need to address, as you heard the commissioner say so clearly, and insurers having difficulty managing concentration and rate adequacy in face of this growing risk. So when you align both the risk reduction and the policy and regulatory system, hopefully that's when we can kind of restore insurability everywhere. And as you heard from the commissioner, there's already been all this great work through the sustainable insurance strategy to address all the needs sort of from a regulatory standpoint, to give insurers access to things like catastrophe models and being able to account for the net cost of reinsurance, because you really can't offer coverage for disaster perils that are correlated and can be catastrophic without tools like modeling and like reinsurance, which helps us diversify these risks globally. So all of that has helped lead to some initial signs of market improvement, as you saw there in terms of the slow growth in the FAIR plan. And as was already mentioned by the commissioner, multiple homeowners companies now making public announcements that they're starting to expand and offer more coverage, particularly in some of these distressed areas under the SIS. Okay, everything I've been talking about till now has really been about availability, because that has really been the acute need in these high fire risk areas, is just having access to insurance coverage. But of course, the other side of that is affordability and being able to afford the price of coverage and afford the necessary coverage that you need. So in California, there's been a long history, though, of trying to keep rates as low as possible. And of course, there's a tension there, because when you keep rates too low and carriers don't feel like they can get adequate weight for the risk, they pull back. And then that's bad for consumers too, right? So you have to have this kind of balance. Between 2007 and 2016, so before those big fires seasons, the average homeowner's insurance premium only went up by 8% in California because of this, compared to 45% nationally. In 22, which is the last year we have comparative data, the homeowner's average premium in the state was still somewhat below the average premium nationally. But as the FAIR plan has expanded and as pricing is higher there because of the higher risk and other things, that change in market composition is also increasing average prices. And you can see broken out here that prices are higher when you're in the high fire risk areas on average, as you would expect. But I also wanted to note that there are many other things that drive the price of insurance besides wildfire risk, right? So if you think about the things that go into a premium, it's the risk of payouts, it's the things like reinsurance that they have to purchase to manage their own risk, it's their cost of doing business, things like agent commissions and paying taxes and stuff like that. But in that risk of payouts bucket, that's the wildfire losses, yes. It's also all the other perils, if we're talking about a homeowner's policy that covers other types of risks. And when you pay out to rebuild a home, what matters a lot is the cost of rebuilding. And that's driven by a lot of macroeconomic things, right? So we saw a prior period of high inflation coming out of COVID. We saw disruptions to supply chains and labor markets. We've seen recent concern about things like tariffs, and all of that has made it more expensive to build. And when it's more expensive to build, that means claims are higher. That means insurers charge more premiums. And that's been responsible for a lot of increasing premiums around the whole country the last basically, I think mostly since coming out of COVID. And so that has also been an added stress on insurance prices recently. And now just to quickly wrap up, I know I'm out of time. On that pricing, I did want to note that due to the Safer from Wildfire regulations adopted by the Department of Insurance, insurers do need to offer premium discounts to policyholders for these defined wildfire mitigation measures. And we've summarized kind of the average premium reduction you can get for those measures, and then pulled it out for some of the largest carriers in the state as well, if anyone wants to take a look at that. So I think that sums things up. Thanks so much for the time.
My goodness, thank you so much, Carolyn, for all of the information that you're sharing. It is so important, and we wanted to go into details so that consumers can see that it's not just something that we are saying, but it is something that it is actually showing in the research. So thank you so much for sharing that. We do have a few questions that came in for you as well that I would love to get your input on. And so the first question is, what role are non-admitted carriers playing as insurers withdraw? Like, what are their pros and cons, and how much of the FAIR Plan burden is shifting to surplus lines options?
Yeah, so the share in the surplus lines has been growing, but it's still really small. So for those on the call who might not know, non-admitted carriers, also called surplus lines insurers, they don't face the same rate and form regulations by the department as admitted carriers do. So they have more flexibility in setting rates and customizing coverage, but they're not backed by the state guarantee fund. So were they to go insolvent, consumers are really stuck on their own. Whereas if an admitted carrier goes insolvent, the state's there to help make sure that all claims are paid. They tend to focus on writing more unique, difficult, or specialized kind of complicated risks. Surplus carriers, though I will note, are not free from regulatory requirements to do business in California. They do have to meet some solvency requirements and market conduct standards, so it's not like they're completely unregulated. So the last data we have for this was 2024, and the total number of policies in the admitted market at that time was about 94%, and like 1.7% was in the surplus lines market, with the rest with the FAIR Plan. Both the FAIR Plan and the surplus lines market have grown in the 2 years since then, so I'm thinking it's like somewhere over 2 right now, but I don't have more recent data than that. So it's definitely increasing, but again, still really small. But we are also seeing more surplus carriers come to do new business in the state. So the number each year entering the market has gone up, signaling greater interest in this.
Good to know. The second question we got is, can communities change or appeal high fire hazard zone designations? And will neighborhood level fire hardening efforts reduce risk classifications and improve insurability?
Yeah. I'm not an expert on the first question. Maybe from CDI or Amy knows. I think a local agency needs to designate the very high fire severity zones by ordinance in a certain amount of time after getting the recommendations from CAL FIRE, but someone else will have to provide more details and nuance on that process. On the second part of the question, though, I mean, yes, at a high level, investments in wildfire risk reduction are needed to improve insurability and should improve insurability. There's a few nuances and caveats, maybe really fast. As you saw already, there is regulation in place in the state that certain discounts are required to be reflected in premium. So you will see some of that. Some of them, though, are quite small. And we're seeing for many carriers, in order to offer more substantial discounts, policyholders really have to adopt suites of measures together, because like a one-off thing might not really bend the loss curve that much. So this is like doing zone 0 and your roof and your vents, right? And then when you kind of do those packages, you can tend to get better discounts. Also, if you're in a very densely built area, what your neighbors do matters a lot. If you're in the WUI, like how the wildlands around you matters. So this is like a community effort. It's a statewide effort. I know there's lots of great work by so many partners around the state working on how you get that community loss reduction to really happen and happen at scale. There's still a few barriers in seeing tighter link into the insurance market despite Safer from Wildfire. Not all the models used by insurers are capturing all the mitigation measures or might not have the most up-to-date data. So we're seeing a lot of efforts to try to solve kind of those particular barriers that still remain. But despite the fact that we still have work to do on making that positive flywheel work as well as it should, I do want to underscore that we need a lot more commitment to loss reduction, since wildfire risk with climate is just increasing and we have to stay ahead of it.
Absolutely. So I have one last one that, this is also your opinion on this. But given the rising enrollment in the FAIR Plan, does it have sufficient reserves to pay claims in a catastrophic fire? And how quickly is the FAIR Plan performance and statistical data being updated, if at all, if you have any information on that?
A quick thing I can say on the data is they make data public on their website. If you just Google FAIR Plan statistics, I'm sure the link will come up. They update that quarterly. The maps that I showed you are using that publicly released FAIR Plan data, so anyone can access that. In terms of claim paying capacity, maybe it's worth noting that Like other residual insurance programs around the country, the FAIR Plan pays claims not just through premiums. So a private insurance company takes in your premiums, they build up some surplus, they purchase reinsurance, and that's how they pay claims. And if they can't pay claims, they go insolvent. So the FAIR Plan and other residual programs do some of that. They take in premiums, they try to build surplus, they purchase reinsurance. The FAIR Plan has also actually just recently purchased a catastrophe bond, but they also have assessment authority. And so if they don't have enough claims, as we saw in LA, the FAIR Plan had authority to assess the industry directly. In other states that do this, like Louisiana and California, that goes directly to policyholders. I know there is a big pass through in California to policyholders too. But so that kind of ex post claims paying ability through assessments is very, very common in these state programs. And unfortunately, there's just this really tough trade-off between higher premiums, which would mean less need to do assessments, or less need to do assessments, or you keep the rates lower, but then afterwards you have these assessments and that ends up distributing the cost differently. So coming back to the mitigation, I'll just say that investments and loss reduction are the only way to really lower all of that, right? And otherwise, we're just kind of shifting who's ultimately bearing the cost, which is a very difficult conversation the state I know has been having. So, yeah.
Well, thank you so much, Carolyn. We really appreciate
Thank you
your
so much for the invitation
expertise,
to be
and
here.
thank you for joining us today. We really appreciate that. And we are also delighted to be joined by Amy Bach, who is the co-founder and executive director of United Policyholders. She serves as the organization's primary spokesperson, shaping and overseeing the roadmap to recovery, roadmap to preparedness, and advocacy and action programs. She is a nationally recognized advocate for policyholders and an expert on insurance trends, claims, coverage, law, and public policy matters. She is a member of the Federal Advisory Committee on Insurance and a consumer representative with the National Association of Insurance Commissioners. Amy, thank you so much for joining us again, and we are so grateful to have you. And the floor is yours.
Thank you so much, Julia. And it was great to see the commissioner and listen to him. And it's a pleasure to be with you. I feel like we have been partners, United Policyholders, the commissioner, and the agency and your team on this journey to bring both stabilization, but also to restore options for California property owners to be able to stay protected at a price they can afford. We've been on this journey together, as you know, for many years. So I'm excited to see the progress that we are making together, and it's my honor to be able to contribute to the program tonight. So just a reminder about the organization that I am speaking for. We are a nonprofit. We are very focused and have been on helping households navigate the new normal, which you heard the commissioner talk about, how you have to think more about insurance now. It's not something anyone wants to think about. But that is really what United Policyholders is about, is helping the regular person who doesn't speak the jargon to really figure out what's my best move here, right? So our organization, when people started getting dropped back in before we had that whole series of bad wildfires here, the fires in the North Bay and up in Paradise and down in Malibu before last year's wildfires in LA, this problem, of course, had already been hitting people hard. So we have been working very, very hard, along with CAL FIRE, the DOI, lots and lots of people across the state, to help people do the things that insurance companies want you to be doing in order for them to be willing to continue to insure you, right? So these are the questions that we've been developing answers to, because these are the questions everybody has. I've been insured with the same company for decades. Why are they dropping me now? That's a really common one. The short answer to that is a combination of technology, right? Now you have a risk score. That's a number that they are looking at. They're using aerial surveillance to look at your house from above. They're using AI, data mining, and they read the headlines and they're processing the claims from these increasingly severe, expensive wildfires that have hit the state, and all the political dynamics that you heard Carolyn talk about with the insurers feeling like they weren't being allowed to charge what they needed to. The commissioner has been very creative with the sustainable insurance strategy, and very collaborative. So where we are now is we're in a much better place than we were. Now we're still not where we want to be, so no one is here to sugarcoat, but to say that we are on the road to the solutions. And there are solutions much more now than there had been 2 years ago, 3 years ago. So is it safe to insure my home through a company I've never heard of? We're hearing that all the time. You heard us talking about admitted, not admitted. I'm going to explain that in a minute. Why should I spend time and money on risk reduction home improvements if I'm still going to lose my insurance and have to go on the FAIR plan? Great question. It's not as likely now as it had been that you won't have a choice, and the rules are in place to reward you. The commissioner, the part of his sustainable insurance strategy is to make sure that insurers do factor in things that you and your community are doing to make it less likely that a wildfire would damage or destroy homes in your area. There's, of course, a lot of sort of, I don't live in the WUI, why should I pay for people who want to live in harm's way? This is a common one. My agent said there's no other options besides the FAIR plan. Well, one thing that we've learned is that a lot of people ended up in the FAIR plan because they were with an agent who only had one choice. That would be, we call them a captive agent, meaning they're only allowed to sell you one company's product. State Farm would be an example. Farmers would be another example. USAA would be another example. They're not brokers. They only can put you with that one company. So if you say to them, well, I'm getting dropped, they don't have any place to put you if that company that they write for doesn't want you. So rather than lose your business, some of those agents have put people in the FAIR plan. We're working on that now because there are, and it's very important that if that's you, that you try another agent and that you shop through somebody who's more of a broker that has multiple options, right? And then what can I do to bring the cost of my insurance down? That's a very, very common question. So just remember there's 4 main types of insurance companies. The ones that you're familiar with, admitted, licensed, and that would be CSAA, Mercury, those are admitted, licensed, State Farm, Farmers. The companies whose ads you see, Safeco and Travelers, those are all admitted, meaning they play by the rules, the department approves their rates, they support the FAIR plan, and if, God forbid, they ran out of money, you have this insolvency fund that they're part of, right? So that's the number one, that's the place you want to be ideally, right? The non-admitted, those are the new kids on the block. Those are some of the names: Kin, Stan, Northlight. You got to really, if you're going to go with one of those brands you've never heard of, very important that you feel confident that the agent that you're working with really knows their stuff and has done their homework, and that the policy they're selling you is going to deliver for you, right? Then you have the FAIR plan, which we've been talking about, or the California Earthquake Authority. Those are government supported. And then you have the type of a policy that if you have a mortgage and you let your insurance lapse, can't afford it, you forget to pay, that mortgage company is going to force place a policy, and they're going to charge the premium, and it's going to go on your mortgage debt, right? So you're paying for it, but it really doesn't protect you. So you want to avoid that. That's very important, okay? I'm not going to stay too long on this. I don't expect any of you to become super experts, but these are just some of the terms that you want to know, right? In California, if your insurer tells you they're not going to insure you again, that's a non-renewal. That's not a cancellation. That's a non-renewal. In our state, your insurance company has to give you 75 days notice before they do that, right? So that's supposed to give you more time to shop. Some states, it's as little as 30 days. California gives you that extra time, and there's legislation that's pending that may give you even more time. So these are just some of the things. If you are on the FAIR plan, you do want to have that difference in conditions patch product if you can afford it, so that your coverage is more the way it was when you had a regular policy. And I mentioned a risk score. That's important. thing for you to know what your risk score is. And thanks to Commissioner Lara's strategy and the rules he's put in place, you do have the right to know what your score is, what score your insurance company has assigned to you. These are the things that insurers are looking for. They want to see that your community is being proactive, that you have something called a FireWise designation, which is not that hard to get, that you have adequate firefighting resources, that there are maybe a program in place that your fire department has where they will send somebody out and inspect and tell you what things you can do to make it less likely that your home will get damaged or destroyed. These are the kind of things they're looking for, right? Is proactivity. And they're looking for not just things that you would do at your house, but they want to see that your neighbors are also doing things and your community is doing things. That's what they're looking for. So these are some of the affordability strategies for the here and now. Find out what discounts are available through your insurer and ask for the ones you qualify for. Bundle your car and home insurance with one company. This is so important. Work with a proactive agent or broker, somebody that is not just sitting around complaining, but is actually beating the bushes and finding new options, because the market is actually a lot more dynamic now. There's lots of action in the home insurance market these days. But you have to be working with an agent that's really staying on top of the new options, right? Raise your deductible. That's really the tried and true way. So most people like these days, if you can stomach it, a $5,000 deductible will definitely bring down the cost of your insurance, and it'll also help you not make small claims, because every claim you file can put you in a higher risk category, which then will make you be paying more for your insurance, right? If you can reduce or eliminate some of the coverages you could live without, like high dollar limits on your contents, or if you don't have a garage and you don't want to have other structures coverage, if your insurer will let you make that change, that can save you some money. But mitigating is so important, and that can be if you have trees or brush around your home, you want to create that 5 feet of clear space that firefighters say is the difference between them being able to save a home and not. You want to, and then you want to give your insurer proof that you did those things, receipts, pictures. Don't file small claims. Put in a moisture sensor, a leak detector. That's a really good thing to do. It's not that expensive, and it will make your insurance company happy. And then reducing your coverage on your home should be a last resort, right? We always tell people stuff is stuff, right? Contents is not as important, but try to keep your home insured for what it might actually cost to put it back, God forbid, if you were to lose it. So just real quickly about what are these rules? What is this sustainable insurance strategy? Every mitigation action is supposed to be rewarded. You saw some chart of some of the discounts, and to be honest, I don't, 5%, 10%, not necessarily going to move the needle for a household in terms of the affordability. But being able to hold on to your insurance moves the needle in a big way. So we're really looking for those renewal commitments, and we're seeing them coming, right? Okay. As a result of the sustainable insurance strategy and the progress we're seeing more insurers willing to insure houses that have a certificate from something called the IBHS, Institute for Business and Home Safety, that says that you have a wildfire prepared home. That's becoming very valuable to be able to get insurance quotes that are reasonable and hold on to your insurance. We're also seeing that some of the insurers who in past years had put a cap on agents, you can only sell 2 new Safeco policies a month, that kind of thing. Those caps are being lifted. So it should be easier when you're shopping to find options. And also part of the commissioner's strategy is to require insurers, as a condition for getting the expedited rate approvals that they want, they have to agree to be insuring more homes in these wildland urban interface areas and what are called distressed areas. These are the zip codes where it's really, really hard to get insurance. So Julia, that was kind of took me to the end of my presentation. Now I've got the questions.
Yes, thank you so much, Amy. You are so thorough and just wonderful. So thank you for doing
Such a
that.
big nerd, I know.
It's wonderful because these are questions that so many consumers have. And so that, that level of explanation is extremely important. So thank you for that. And yes, so the first question that was asked was, what actions are being taken to help condo associations, HOAs, and high-rise buildings access affordable fire insurance, including the HO6 availability and coverage for non-warrantable communities?
So condo owners and HOAs have been hit very hard by the changes that insurers have been making to who they're willing to insure and where. One reason is that condos, because they're shared walls, tend to have more water damage claims. And there tends to be sometimes there's some fights over, well, who's responsible, right? Is it the unit owner? Is it the HOA? And because of that, insurers have really cut back on their willingness to continue to insure condos and HOAs. So we've done a couple things to help. We have made it easier for condo associations to get coverage through the FAIR plan by increasing the amount of insurance you can buy through the FAIR plan. We are seeing some entrepreneurial activity, more from these non-admitted. The new kids on the block are showing more interest in insuring condos, but they are gonna put in the policy some usually like a pretty low cap on what they'll pay for water claims. So that's something to be aware of. The other issue, if you are going with a new kid on the block insurance company, is that because the DOI, the commissioner and his team, don't review their rates and their forms, you got to be extra careful of what that policy says. So, for example, we recently saw a policy that was offered by one of these new kids on the block, I'll call them non-admitted, that had a 50% wildfire deductible. Now, the department does not approve wildfire deductibles. In fact, they're really not legal, but you don't want to have that fight, right? You want to really, if you're going to go that direction, you really have to work with an agent and put them to their pace, put them through the pace and say, look, if you're going to put me with this company I never heard of, please do your homework and make sure that this product is going to actually deliver for me if, God forbid, I have a claim, right? So just be careful, right? With non-warrantable, that's where you've got some issue where, there's a large number of the units in a condo that are owned by one person or other type of things. And some of those issues go beyond insurance into just financing, right?
Yeah.
So that's that answer.
Yeah, thank you so much, Amy. And then, of course, what resources or guidance exists for homeowners who are canceled, non-renewed, or in escrow and are unable to obtain coverage, especially in high-risk areas such as foothills regions, Morgan Hills, Santa Cruz Mountains, Pacific Palisades, and Altadena.
So, yes, we can answer questions without chapter and verse. So this is going to be a short one. United Policyholders has pulled together lots of resources to answer this question and this one URL, right? You can just do uphelp.org/CA insurance help. And that will bring you to a page where you'll find all kinds of tips, including links to the department's website. Their non-renewal moratoriums that the commissioner has put in place that are very helpful. If you live in an area where there's been a wildfire recently or right next to one, you may have protection in place that can help you. But this is really where you're going to find the short trip to the shopping help. We, United Policyholders, twice a year, we have been doing a California shopping help webinar. The department helps us with that. We always bring a panel of agents and brokers from different parts of the state to answer questions. We're going to be doing one of those again in a couple months, but the last one we did is still pretty pretty up to date. Also, this is from my organization's website. This is our WRAP Resource Center, Wildfire Risk Reduction Asset Protection Resource Center. This one, you go to this link, you click on your county, and you're going to find suggestions. What can you do to make your home more attractive to an insurance company and qualify for a better, cheaper options? Who's offering help in your area? How can you get your home inspected? How can you get somebody to come out and give you that good housekeeping stamp of approval that you've done the things? You put screens over your vents to keep embers from coming in. You replace that section of wooden fence that touches your home with a metal gate, that kind of thing. Okay.
All right, and then the last one, and we're finishing up strong here. How will insurers incorporate accurate wildfire risk data, such as defensible space, fuels treatments, fire-wise programs, zone zero compliance, and ground truthing into price grids and discounts?
Well, there's a lot of work going into this exact goal, right? To get insurance companies to respect and take into account in their pricing and in their sales decisions all the work that communities are doing. And there's a lot of it. It's not just communities, it's utilities, undergrounding or putting in safer wires. It's things that the local fire department might be doing to what they call to create fuel breaks, shaded fuel breaks, that kind of thing. So we're building the channels, but right now, as those channels are being built to make sure that the insurance companies' rates, their sales rules, what are called underwriting guidelines, are in fact being adjusted so that people are getting the proper rewards that they should be getting for all the work and the money and time that they're putting in to reducing risk, right? So right now, you can self-report any of your completed mitigations, or you can work with a vendor. There's a bunch of them now. There's sort of a gold rush going on in California with companies that will come out to your home, tell you what to do, maybe do the work for you, and then give you this certificate that will help you get insurance. Some areas have your fire departments doing it. If you live in Marin, you live in Ventura, you live in Sonoma, your county may have a program to help get your home inspected, give you the prescription, help you fill the prescription, do the stuff, and then get rewarded, right? So we're very hard at work on this. The department is hard at work. Our organization and our working group is hard at work building those channels because, and we're seeing some progress. We have seen one insurer, a domestic insurer, went up to Paradise, saw the work that the community was doing and said, you know what? And very grateful to the commissioner and his team for having put the sustainable insurance strategy in place. And they said, okay, we're going to insure another couple hundred homes here. We had the same thing is happening in Lake County, where there's a pilot, and the insurers are starting to be believers. And I've got the fourth insurance company now that has agreed to present to our working group to sort of brag about the way that they are now rewarding people and communities that are reducing risk. So I'm very proud that we are turning a corner. The insurance industry usually doesn't do anything quickly. People often talk about it like a big ocean liner that takes a while to turn. But we are definitely on the road, and in large measure, because the commissioner and his team have been bold, they've been brave, and they've been doing the hard work, and it is starting to pay off. And we're very, very grateful to be part of the progress.
Thank you so very much, Amy. All of your tips, the information that you have shared is invaluable. So we will be sharing all of that with everyone who signed up for this event. So you will get all of that information. But truly appreciate all of your time and all of the tips that you were able to share today. So thank you. And I would like to thank all of you who joined us today, and those of you who submitted your questions prior to the event. We expect your questions with, all of those that a lot of your questions were answered through the conversation, but we do want to remind you that if we did not address your particular question, please contact the Department of Insurance experts at 800-927-4357 or through our website at insurance.ca.gov. They will be able to help you directly, and you will be able to share that. If I can have Sulaimi, if you can share the information where people can see that. We also would like to invite you to our statewide education series webinars. The next one is focused on business insurance and is scheduled for October 21st. If you have missed any of our earlier webinars, these recordings are available in our website. So I invite you to take a look at your, at your convenience. And also, we have consumer alerts, and this is an easy way to keep in touch with us as well. We post updates on the work we are doing, including regulations, fraud prevention, and it's all the timely insurance issues that you may need to hear from us. We have information coming up soon in regards to the grants, the grant program for homeowners who are in need, who will be able to utilize some of those grants to upgrade their roofs, or utilize those to do some mitigation. And then finally, we do care about what you think. So if you have some time available, please give us your feedback. As always, our experts are available to help you navigate any and all insurance related questions you may have. And so you can reach them again at 800-927-4357. or at our website at insurance.ca.gov, where you can have a conversation with us, or even chat online as well if you don't want to talk to someone there. We do have the availability for you to submit a request for assistance, and we will be able to help answer any type of question that you may have about insurance and guide you in your search for insurance as well. So thank you again for your time, and I hope that you have a wonderful rest of the night.